Well, here we are in the aftermath of the March FOMC meeting, a meeting at which the Federal Reserve elected not to raise the target for the federal funds rate and adopted what we would phrase as a very dovish policy statement and set of projections. And so we've been receiving a lot of questions. Is there some shift in the Fed's thinking? Is the Fed, for example, embracing at long last its role as the premier global central bank? Are they reacting to the role of the dollar on a global basis and its effect on other countries? We think a simple story is the best story here, as it often is with markets. And the simple story is just that the Fed was spooked early in the year by the financial market volatility that followed the first rate hike. And they worry that some events globally may have ramifications for the U.S. economic data. And they'd rather have a cautious approach, take a pause at this meeting and see whether the data actually does react before moving again. They still have 2 rate hikes penciled in if you look at the dots on the infamous dot plot. So they do plan to hike again, and this is a pause. Now, what we would say is that we have a more upbeat take on much of the economic data. In particular, I want to highlight one area where I think we have a very distinct divergent view from the Fed's view, and that's on inflation. If you look at the Fed's outlook for inflation, they have core PCE, which is their preferred gauge, at 1.6% at the end of this year. Right now, ladies and gentlemen, core PCE is at 1.7%. as we sit here. So they have inflation slowing as the year proceeds. Janet Yellen was asked about this briefly at the press conference after the meeting, and it was clear to us that she is not convinced that the upward trend that we've seen in core inflation will be sustained. She worries that there's risk that it will actually move lower as the year progresses. And when we digest the data and look across a lot of different ways of slicing the inflation data, we think core PCE will move higher as the year progresses. If we're right, that means the Fed could hike 2 or maybe even 3 times over the course of 2016. And we think this is really important for financial market participants to think about. Right now, though, financial markets have reacted very positively to the dovish message sent by the Fed. Equities are up, treasury yields are down, commodity prices have rebounded. But if we're right and inflation is actually on a more sustained uptrend, we think that will have implications for markets as the year proceeds.